How banks make money, and how they don't. When it comes to banks, have you ever wondered how they make money? Or perhaps, how they don't? Today, we'll take a closer look at the ways banks generate revenue and the challenges they face in doing so. Deposit accounts. One of the most basic functions of a bank is to accept deposits from individuals and businesses. Checking and savings accounts represent two of the most common types of deposit accounts. While these accounts do generate some revenue for banks in the form of interest payments, the current low interest rate environment makes it difficult for banks to turn a profit on these accounts alone. As a result, banks typically rely on other sources of revenue, such as interchange fees and loan origination, to offset the costs of managing deposit accounts. Loan origination. Lending represents one of the primary ways banks make money. When a borrower takes out a loan, the bank charges interest on top of the principal amount. Interest rates vary depending on the type of loan, the borrower's creditworthiness, and market conditions. Generally speaking, higher interest rates translate into greater profits for banks. However, banks must also absorb the costs of underwriting loans, processing paperwork, and servicing accounts. Moreover, if a borrower fails to repay a loan, the bank may suffer losses, potentially wiping out any gains made from interest payments. Interchange fees. Another key source of revenue for banks is interchange fees. Interchange fees are assessed whenever a consumer uses a debit or credit card to make a purchase. The merchant pays these fees directly to the issuing bank, generating significant revenue for the bank over time. According to recent estimates, interchange fees generated approximately $60 billion in revenue for U.S. banks in 2019 alone. However, regulators have taken steps to cap interchange fees in recent years, citing concerns over anti-competitive practices and excessive profits. Investment banking. For larger banks, investment banking represents a substantial source of revenue. Investment banks help companies raise capital by underwriting stocks and bonds. They also advise clients on mergers and acquisitions, restructuring, and other strategic transactions. Because these services require specialized expertise and resources, investment banks charge hefty fees for their work. However, investment banking is also subject to strict regulation and oversight, particularly following the global financial crisis of regulatory requirements. Like all industries, banks operate within a framework of laws and regulations designed to promote transparency, fairness, and stability. Banks must comply with numerous rules governing everything from data privacy to anti-money laundering measures. Compliance can be expensive, requiring banks to invest in technology, personnel, and reporting systems. Moreover, certain regulations limit the types of investments banks can make, constraining their ability to generate revenue in other areas. Economic cycles. Finally, banks are subject to broader economic forces beyond their control. During recessions, for example, loan defaults increase, leading to losses for banks. Similarly, during periods of low interest rates, banks may struggle to generate sufficient revenue from deposit accounts. Conversely, during periods of economic growth, banks may enjoy increased demand for loans and other financial products, driving revenues higher. Understanding how banks make money involves examining a range of factors, from interest rates and fee structures to regulatory requirements and economic cycles. By appreciating the complexity of bank finance, consumers can make informed decisions about their own financial lives, choosing the right products and services to meet their needs. Answer true or false to the following statements. Banks primarily make money by charging interest on loans. True. All types of deposit accounts, such as checking and savings accounts, generate substantial revenue for banks. False. While deposit accounts do generate some revenue for banks, the current low interest rate environment makes it difficult for banks to turn a profit on these accounts alone. Interchange fees are paid by merchants directly to consumers when they use a debit or credit card. False. Interchange fees are paid by merchants directly to the issuing bank, not to consumers. Investment banking represents a significant source of revenue for smaller banks. False. Investment banking is generally only a significant source of revenue for larger banks due to the need for specialized expertise and resources. Regulatory compliance is a minor expense for banks compared to other operating costs. False. Compliance can be expensive, requiring banks to invest in technology, personnel, and reporting systems. Economic downturns always lead to decreased revenue for banks. False. While economic downturns can certainly impact bank revenue, there are other factors that can drive revenue up or down, such as changes in interest rates or demand for financial products. Thanks for watching. Make sure you subscribe to our channel, comment, and press the like button.